Hi, welcome everybody to our presentation about real estate tax benefits in the One Big Beautiful Bill, the OBBB, um, as people call it. My name is Michael Wiener. I am a tax partner here at Greenberg Glusker. My practice revolves largely around the real estate industry and tax issues related to the real estate industry, specifically 1031 exchanges, partnership tax issues, California state and local real property and transfer tax issues. And since 2018, when these things came into existence, qualified opportunity zones and qualified opportunity zones is something that we're really going to talk about a lot, and they're really cool. And I'm sure a lot of people are already familiar with the basics. Skype.
No, I'll do mine when I start.
Oh, okay. And I guess just as a reminder, that there will be a link to the MCLE certificate, the evaluation form, and the presentation handout in the chat box, and that will be shared towards the end of the program. It'll also be sent to you via email within the next 24 hours. And today's program handout is also currently accessible from the 1-hour Zoom reminder sent this morning. If you have any questions during the presentation, please submit them in the Q&A box. We'll answer them most likely via email with a written response after the program has ended, but please submit as many questions as you would like. So on July 4th, just less than 3 weeks ago, the president signed into law the One Big Beautiful Bill Act, and it includes a lot of stuff, a lot of tax issues. I mean, tax notes sent around a version of just the tax provisions, and the text was, still about 500 pages. So there's a lot of stuff. We're gonna focus here on the issues that really are relevant to the real, or on a number of the issues that are relevant to the real estate industry. There are a lot. Like I said, there's a lot in this bill, and there's a lot of things that indirectly affect the real estate industry that we're probably not going to touch on, such as the changes to the interest expense limitations and the qualified business income pass through tax benefits that were preserved. But we're going to get started, as I mentioned a minute ago, with probably the biggest, or certainly one of the most talked about parts of the bill that affects real estate, and that is qualified opportunity zones. So just as by way of background, qualified opportunity zones came into existence as a result of the Tax Cuts and Jobs Act of 2017. The zones were designated in 2018, and basically the overview of the tax benefit, as we call it, for Opportunity Zone 1.0, which was what was enacted by the TCJA, is that if you invested in a qualified opportunity fund, basically if you invest in a qualified opportunity zone investment, you would get a deferral of your capital gain to the extent that you made an investment until December 31st, 2026. If you held that investment for 5 years, you would get a 10% basis step up in order to basically offset 10% of that deferred gain. And if you held it for 7 years before 2026, which basically meant you had to make your investment by the end of 2019, you would get a 7-year, or you would get a 15% basis step up, or essentially 15% of your gain would be excluded. And the real benefit, the cream of the crop, was that if you held your investment for at least 10 years, then all of your post investment gain would be excluded from federal income tax.
No.
And the key feature, or one of the key features of Opportunity Zone 1.0 was that it had a sunset date. It expires, it still does, on December 31st, 2026, meaning you cannot make an investment in a qualified opportunity fund after that date, or really because of how the rules for 180 days work into 2027, and get any of the benefits of the qualified opportunity zone statute. And what they did in the OBBB is, well, they made opportunity zones permanent. There was some talk about extending that date to 2028, the 2026 date to 2028, 2030. In the end of the day, they said, no, we're just going to make it permanent, and we're going to make it sort of, I guess, renew itself every 10 years. So let's get into exactly what that means. The opportunity zone section of the OBBB really contains four subsections. The first relates to designations of opportunity zones. So we've got to get into what are opportunity zones. Basically, opportunity zones are quote unquote low-income communities or census tracts that are low-income communities that are designated by the governor and approved by the Treasury Department. And under OZ 1.0, that process was done during 2018. Now, under Opportunity Zones 1.0, or under the TCJA, I should say, the designation of a census tract as a qualified opportunity zone is set to expire December 31st, 2028. Now, it's not 100% clear what happens to these existing opportunity zones after December 31st, 2026, which is when the new opportunity zones come into effect. So just a word, proceed with caution. The way the statute is drafted is, complex, and I suspect we'll probably need some guidance from Treasury on that issue. Basically, what's going to happen in 2026 is, in the second half of 2026, governors, starting in July, governors are going to designate a new set of qualified opportunity zones and submit them for approval by the Treasury. And those opportunity zones will become effective on January 1st, 2027. Now, what the bill does is it narrows the definition of low-income community. Previously, under Opportunity Zones 1.0, a low-income community could be up to 80% of the median family income. Now that number is reduced to 70%. And the result is that there are going to be, because there are going to be fewer census tracts that qualify as low-income communities, there are going to be fewer opportunity zones, because I should back up, the maximum number of opportunity zones in the state is equal to 25% of the quote unquote low income communities. So fewer lower income communities is going to mean fewer opportunity zones. People are speculating anywhere approximately 22% fewer. I heard somebody say 25% fewer. We don't exactly know. But the map is going to be redrawn. And like I said, this process is going to start in July of 2026. And I think we can expect to get the new list of opportunity zones probably in, I would guess, November or maybe December of 2026 that become effective in 2027. There are, timelines that they have to, submit their lists, and timelines that they have to approve it, but those timelines can be extended. So assume that we'll get it, towards the end of 2026. In addition, and this is, a nuance, under OZ 1.0, most of the island of Puerto Rico was a qualified opportunity zone, because they said all low-income communities in Puerto Rico can be qualified opportunity zones. That is repealed. Now Puerto Rico is treated just like anywhere else as far as opportunity zones go. So you have these new opportunity zones that go into effect in 2027. And this process is going to repeat itself every 10 years. So again, in July of 2036, governors are going to designate a new slate of census tracts as opportunity zones. And those will be submitted for approval by the Treasury, and those will go into effect in 2037. And so on and so forth. Like I said, the program is now permanent and renews or reinvents itself every 10 years. Another just potential consequence of all of this is that, or consequence of the narrower definition of low-income community, is that you may not see as many prime areas get designated as opportunity zones going forward. They also, I should say, under Opportunity Zone 1.0, they could designate a census tract that was directly adjacent to a low-income community as an opportunity zone, and they can no longer do that. That was taken away. So, okay, great. We get to 2027. What else do they do? Well, as I said, under Opportunity Zones 1.0, you had a fixed deferral date, December 31st, 2026. And that didn't change, and that doesn't change for anybody. Now, under Opportunity Zones 2.0, you'll get a rolling 5-year deferral date. So you will be able to defer everyone, regardless of when you make your investment in a qualified opportunity zone, will be able to defer their capital gains for 5 years from the date that they make their investment. And that means, in reality, so just to back up for a second, you still have 180 days from the date of your capital gain to invest your capital gains, to roll them over into a qualified opportunity fund or a QOF. That has not changed, but given that in a lot of instances, specifically pass-through, when it comes to gain that's allocated to taxpayers through a pass-through entity, namely a partnership or an S corporation, you have really a lot of flexibility as to when that 180-day period starts. You, in a lot of cases, will actually wind up with a 6-year deferral. Let's say that you have your capital gain event in, let's just say, the beginning of 2027. You have capital gain allocated to you through a pass-through entity. Okay, under the current Treasury regulations, which these regulations I don't anticipate changing. I think overall the regulations will have to be updated, but this specific rule probably wouldn't. You could potentially start your 180-day period on March 15th of 2028, which means that if you make your investment then at some point in 2028, you're going to have until 2033 for the deferral. So really, you'll get 6 years of deferral. The rules about when that gain is, or the rules about how that gain is ultimately recognized, stay the same. The nature of the gain gets preserved. Meaning if you have long-term capital gain, it's still going to be long-term capital gain. If you have short-term capital gain, it's still going to be short-term capital gain, et cetera, et cetera. And you will be subject to the tax rates that are in effect at the time of your quote unquote deferral end date. So in my example that I gave, where somebody has a capital gain event in 2027 and they wind up being able to defer to 2033, they will owe tax on that amount at the capital gains rate that is in effect in 2033, whether that's either going to be higher, lower, or the same as now. No other option. So there's a little bit of gamesmanship there. One thing that they did not do is that was talked about, and I was hoping they would do in one of the criticisms of the initial program, is they did not allow for what I'm going to call non-gain investment, meaning that you can only get the benefits, and not talking about the deferral benefit, the ultimate 10-year exclusion benefit, obviously the deferral benefit, but you can only get the 10-year exclusion benefit if you invest rolled over capital gain. You cannot invest non-gain money and still get an exclusion from income at the end of 10 years. So that is, that is something that stayed the same. In addition, the way that, sort of the transition from opportunity zones 1.0 to opportunity zones 2.0 is kind of tricky. And like I said earlier, with regards to, the status of current opportunity zones is a little bit unclear, but it also creates this potential dead zone, as people refer to it, which is, well, if somebody has a capital gain event in 2026 and the deferral is important to them, they may be, disincentivized to actually make their investment in a qualified opportunity fund until 2027, when they can take advantage of the new rules. On the other hand, the reasons to make a opportunity zone investment in 2026, even if you can, push it off until 2027, is that one, you start your 10-year clock earlier, and that may be important. If it's the beginning of 2026 versus the end, meaning if it's the beginning of 2026, and let's say it's through a pass-through so that you have the option to wait until 2027, you may not want to just wait a full year. If your capital gain event is at the end of 2026 and it's just waiting a few weeks, maybe, maybe people do. Maybe then they say, yeah, forget it, we'll just, do it in 2027. But also now, we know where the opportunity zones are, and you have a number of areas that are, really good areas that are, prime areas that are still considered qualified opportunity zones. I remember, right when the program was starting, I had a client who was selling an office building for, a nine-figure sales price. And just so happened to be in an opportunity zone, and it was not in an area that I would have considered to be quote unquote, low income. So, I think you're going to have fewer of those areas now, or fewer of those areas starting in 2027. And as a result, if you want to try to make a qualified opportunity zone investment in a quote unquote better area, doing it before the new rules kick in may be the move. Sky, do you want to talk about the 10-year exclusion?
Yeah, I'll do that. I'll be talking about that.
Okay. And so I'll just say one last thing, I guess, before I turn it over to Sky here, is that the OBBBA also creates a new concept called a qualified rural opportunity fund, or what I've heard some people refer to as a CROF, which is a qualified opportunity fund that invests 90% of its assets in rural areas. And rural has a very technical definition. It basically excludes, and let's see if I have this memorized. If not, I may look down at my notes. Rural basically is any area but a metropolitan area with I don't remember
50,000.
50,000. Okay, Sky had that off the top of his head. At least 50,000 or any tract that's directly adjacent to one of these metropolitan areas. And
There you go.
Rural investments really have two benefits. Well, actually, sorry, I skipped over one concept of the 5-year deferral date, is that you will get a 10% basis step up. So you will get 10% of your gain just chopped off the top.
I'll cover that as long with the
Okay.
rural
All
step
right.
up. I'll do those.
Okay, yeah. Whereas for rural, as Sky will cover, you get a much larger percentage. And also for rural funds, the substantial improvement requirement has been reduced. Generally, for qualified opportunity zone property, it needs to either be quote unquote original use property or substantially improved. And substantial improvement generally means that you make additions equal to 100% of basis to that property. For rural property, you don't need to add 100% of the basis, you only need to add 50% of the basis, and that is effective as of July 4th, 2025, when the bill was signed into law. Scott, you want to talk about the basis step-ups and the
Yep. Yep. We good to go? I'm good to go.
You're good to go.
All right. So I want the good news for everybody, do the MCLA thing. For anybody that needs MCLA certificate, just reminder, because I saw a lot of people joining, there will be a link to the MCLE certificate, the evaluation form, and our handout will be in the chat box, added to the chat box at the end of the program, and will be sent via email in the next 24 hours. So all that will be available. And my background is I am always been a tax nerd my whole career, which has been way too long. So a partner at Greenberg Glusker, honored to be partners with Michael and Skip Kessler.
I'm honored to be partners with Sky and
and I do all things tax. I can't stop myself. So I do foreign entertainment, California, income, in withholding, anything. So and jumped all over this real estate because it's amazing benefits for the real estate. So what I want to do is just summarize the benefits for opportunity zones just very quickly. What are the benefits for people investing in them? And they really are astounding. Number one, you get to roll over any capital gain that you have, and you get to defer it, including the 3.8% net investment tax, so that all the tax on the gain is deferred until the earlier of 5 years from the date that you invest in a fund, in a qualified opportunities of fund, or the date that you sell your interest in the fund, or that you recognize gain if the fund makes a distribution in excess of your basis, or if the fund during that 5-year period fails to qualify as a qualified opportunity fund, if it for any number of reasons, if it doesn't have enough property in a zone, if it sells it or liquidates, everything gets picked up. That's called an inclusion event. So benefit number one, deferral of gain for basically at least 5 years, if you hold on to it. Number two, 10% of the gain disappears at the end of 5 years completely, so that you don't even have to recognize any tax on that. And 30% of the tax of the gain disappears if the fund is invested in a rural, 90% of its assets are in a rural area, which is outside a city that has not adjacent to or in a city that has 50,000 residents. And so that there'll obviously be a lot of funds, and they're going to be called rural opportunity funds that invest solely in rural areas to meet that test, because it has to be a 90% test. In all cases, the gain that the deferred gain is limited to the value of the fund, of your fund interest at the time of inclusion, whether it's at 5 years or you sell your interest. So you'll never have to recognize more gain than you actually have at the end of the day. And then the gain, when it is recognized, is the same character as in the year of sale, based on the rates that are in effect in the year of recognition, of the year of that the deferred gain is picked up. The biggest benefit, and the one that I think that is just phenomenal, is that there is no tax at all on any gain recognized on the interest in the fund beyond that deferred piece. So if you roll over $100 into a fund, 5 years later you recognize $100 as gain, fine. But if that fund now goes up to $1 million, you will not recognize any further tax. You don't have to pay tax at all on the additional gain that is recognized if you've held that fund interest for 10 years, even if the fund no longer qualifies as a fund after 5 years. And that is our interpretation of it. I think it follows from the regulations under the existing thing. So what's key about this is that Once you've held on for 5 years, it no longer has to be a qualified opportunity fund for you to get the benefit of this complete exemption from gain. So if you hold on to it for 10 years, and the amazing thing to me is not even recapture. Like when you sell it, whenever you don't even have 751, you don't have 1245, you don't have any recapture of any ordinary income, including, so you get to depreciate any depreciation you've taken, whether it's including attributable to debt, for example. There's not even gain attributable to debt in excess of basis. And so, that is just a phenomenal benefit. And even an additional benefit is that you're allowed to borrow against your fund interest, and that is not treated as a sale of your interest and does not trigger gain. It's not what's called an inclusion event. So in the interim, or even during the 5 years, you can borrow against, you can basically cash out your interest by borrowing against it. You held on for 10 years, you can take all the depreciation, from debt at the fund level, and then you sell your interest and no gain, including no recapture, no debt in excess of basis. So you've got the benefit of all this additional depreciation. I mean, it really is a phenomenal benefit. If you've held the interest for 30 years, the party stops at 30 years. You get a basis equal to the market value at that time, and anything further you would recognize gain, but that'll be far and few between people that hold more than 30 years. But that's how it will work. The one thing to add is that the benefit applies as long as you've held for 10 years, even if the fund itself sells the property itself. You as a fund owner, if you've held it for 10 years, will not have to pay any tax on the gain. So the fund in theory could be selling the qualified opportunity zone property, roll it into something else, and as long as you've held for 10 years, the gain on that sale would not be subject to tax. So that's it. Just the summary is, I just think it's just phenomenal benefit, and I expect billions of dollars to be rolling into opportunity zone funds. And the real game is everyone's going to be trying to figure out what will be the new fund, where will be the new zones based on this new test, because people want to be investing in it prior to 2027 when the new rules go into effect. And with that, the downside of this is that there's new extensive reporting rules, and I'm going to let Mike summarize those.
So just a couple of things to just add to Sky's, phenomenal summary. Is one, as Sky said, well, you can borrow against your fund interest, and that's absolutely correct. You can even, finance the entire acquisition of your fund interest, meaning if you have capital gain and you recognize $100, you take that $100 and put it in your pocket, and you borrow $100 and use that to buy the fund. So it's not like, people often like to compare, opportunity zones and 1031s. The only thing they have in common is the number 180 days, and they don't even have that in common, because in opportunity zones, the date of the sale counts, so it's actually 179 days. But the only downside to this that I would add is that, at least to date, California has not conformed to the opportunity zone benefits. There's some question about whether, now that there's stricter parameters about what constitutes a low income community and this and that, whether California is going to conform. Your guess is as good as mine. But from a federal perspective, the benefits are really truly phenomenal, and for people who are not affected by California tax, in other states that do conform, the benefits are really great. So we'll talk about the new reporting requirements, briefly. Basically, because the program under OZ 1.0 got some flack because people were saying, well, these are investments that people are going to make anyways, and there was that definitely that spirit when you would attend these opportunity zone conferences. They would say only do a deal if you're going to do it without regard to the tax benefits. And sort of the I would call the poster boy for all of this was the Las Vegas Raiders stadium which happens to be in an opportunity zone. So in order to, combat that, they have instituted some new reporting requirements. Previously, under Opportunity Zones 1.0, qualified opportunity funds just needed to, basically, you file Form 8996 and you would say, well, the name, here's, your fund, here's the value of your total assets, here's the value of your qualified opportunity fund assets. And, if, you don't meet the 90% test, well, here's, you'll calculate your penalty, et cetera, et cetera. But, oh yeah, and it would have to, include the EIN for any corporation or partnership that they owned an interest in. So now, opportunity funds are required to submit additional information, and presumably Form 8996 is going to be revised to include this. They have to include the North American Industry Classification System, the NAICS code that applies to its trade or business, and or to any trades or businesses or to the trades or businesses for any qualified opportunities on businesses, any corporations or partnerships owned by the QOF. One thing we also did not touch on, just because I mentioned it now, is that qualified opportunity zone is a qualified opportunity zone business concept. The idea that most opportunity zone deals have to really be done, and this is outside the scope of what we're talking about, through a subsidiary, partnership or corporation. That has not changed in the bill. That is still the same. So you're going to see these, deals get structured in largely a similar manner. So they have to include that. They also have to include the number of residential units, if applicable, that they own, and they have to include the number of full-time or full-time equivalent employees, and that is a very technical definition, so that the government is able to track, well, what is the employment impact of this opportunity funds investment. Opportunity funds are also required to furnish statements to their investors that dispose of their interests. Presumably that would extend to, I suppose, all inclusion events may be under regulations during the year, and those statements have to include, amongst other things, the date on which the investment was acquired and the date that it was sold. And now, in addition, currently qualified opportunities on businesses, these subsidiary, in most cases, partnerships that actually do own the deals and that do the deals, had no reporting requirements. They are now going to have to, furnish statements to the qualified opportunity funds that allow the qualified opportunity funds to comply with their reporting requirements. I guess we'll see if the IRS, issues a specific form that these reports have to take. But, we'll see what happens there. And, the upshot, the important part of all this, why it really matters, is because there are penalties if an opportunity fund does not meet its reporting requirements. And those penalties are going to be $500 per day and up to a maximum of $10,000 per return for a quote unquote small fund, and up to $50,000 per return for a quote unquote large fund. And the line of demarcation between large fund and small fund is $10 million of gross assets. So a small fund will have gross assets of $10 million or less. A large fund is going to have gross assets in excess of $10 million. And if the failure to comply is due to quote unquote intentional disregard, then the penalty gets jacked up to $2,500 a day, with a per return maximum of $50,000 for small funds and $250,000 for large funds. So it's going to be very important that these reporting requirements are complied with. The reporting requirements will become effective in 2026. which means that, on the 2026 returns, which are filed in 2027, this information is going to have to be included. Sky, do you have anything else you want to share on opportunity funds, or we move on to
Nope.
bonus and one
Yeah.
second?
I'm gonna.
All right. So, the other the next topic we're gonna cover is bonus depreciation and 179 expensing. So
No, I'm going to do the buildings.
oh, you're gonna do the bill. Okay, sorry.
Yeah. Okay. So the next topic is the one that my favorite of all of this, and I think everyone should really pay attention to this because it is a phenomenal, unbelievable benefit. And I walked into it the day after the bill was passed. I have a client that's absolutely teed up to do this. There's now 100% deduction for the cost of buying or constructing a building in the United States, as long as the following requirements are met. The building has to be used for manufacturing tangible personal property, or refining, presumably minerals, or for the production of agricultural production or chemical products, whatever that means. But the big one, the main one, is going to be manufacturing tangible personal property. So if you buy a building and convert it to manufacturing or construct it, 100% deduction on the day that it's placed in service, as long as it's used for one of those purposes, and the original, we'll call that a qualified use. That is manufacturing, refining, or producing. As long as that qualified use starts with when it's first placed in service, or most importantly, if the building has not been used for a qualified use for the last 5 years, basically from through 2020 through May 2025. And the purchase and construction has to occur after January 19th, 2025. And the building has to be placed in service before 2031. And so, I mean, I just do an example of what just happened. The day after this happened, a client calls me up and they say, I'm selling this office building, and the buyer is going to convert it into manufacturing headphones, and they're going to convert it this year. And it's like, oh my God. And it was a $16 million building, 1 million of land. The deduction only applies to the building, not the land. And it gives the ability of partners to come into the buyer and make the buyer an LLC, and you can allocate the deductions to the new investors. And it's just, like, are you kidding? It's like you get 100% deduction for the cost of buying a building. And the building had been an office building, had never been used for manufacturing, and so it qualified as this, that it hadn't previously been used, and it didn't even need to be constructed. It was just a new purchase, and so it is a phenomenal benefit. You can allocate if you do it right, depending on your following 704B. You can do the allocations of non-recourse debt deductions. It is, though, a passive loss, and therefore you do have to find people that either have passive income or that can be active in the business. And in our case, we have investors that can be active in the business. We'll be able to meet the active test, and so we're going to be able to do that. And the only downside of it is that the deduction is treated as recapture, subject to recapture in certain events under 1245, and I'm going to let Mike address that, because that's the only downside of it on the flip side. And so I'll leave it. Yeah.
Well, then that's consistent with how expensing is done for bonus depreciation, or certainly also 179 expensing. That also becomes 1245 property. Basically, what what Sky is referring to is that this property, that this building that Sky's client is just expensing, is called qualified production property, is the technical name given to it in the act. It becomes included in the definition of what's called, quote unquote, section 1245 property, which generally is tangible personal property that would be used in a trade or business, but can also, in certain instances like this, include real property. And under section 1245, when you sell section 1245 property, you will have depreciation recapture at ordinary income to the extent that you either took depreciation on that building, which in this case, yes, you depreciated it 100%, or the fair market value of that property, whichever whichever is less. But here you depreciate, or whichever is whichever is less. But or you'll have I explained that poorly. You'll you'll have depreciation recapture of the amount that you depreciated up to the extent up to the fair market value of the property. And so here you will have your, you depreciated 100%, you expended you expensed it. So pretty much any gain that you have on the sale of the building will be recaptured as ordinary income. And that creates a few issues here. The first is that as Sky mentioned, if you finance it with debt in a partnership, you'll have allocations of non-recourse debt deductions, and you want to make sure that those are allocated as you want them to. This is a personal pet peeve of mine in general. Non-recourse debt allocation deductions. It's usually one sentence in the middle of what I'm going to call the 5 pages of tax jargon that appears in the middle of every partnership agreement, and that people usually gloss over. But it is incredibly important because you have a lot more flexibility to allocate these among the partners than you do for other types of deductions. So that's one thing. The second thing is, as I said, you'll have ordinary income when you sell it. The third is it creates some hot asset issues for partnerships when partnerships sell. And then finally, this is an area that while 1031 exchanges were not expressly covered in the OBBB, this is an area that does implicate section 1031, because Sky's client is going to say, okay, I depreciated this building, okay, I fully expensed it, my basis is 0, and if I sell in a taxable sale, any gain attributable to the building is going to be ordinary income. But what if I sell it and I do a 1031 exchange into another property? Well, did I just beat the system? And the answer is not necessarily, potentially, and sort of. Basically, section 1245 recapture, this recapture of ordinary income or depreciation recapture overrides section 1031, and the rules are intricate and very worded in a very complex way in the regulations. But the upshot is that in a 1031 exchange, you have to exchange either equal or up in section 1245, in quote unquote section 1245 property. Until now, this really has been an issue in another topic we're going to discuss if we have time, which is bonus depreciation and cost segregation studies. But if you have, section 1245, if you sell, let's say Sky's client sells the building, they took $15 million of, bonus of, immediate expensing, and they sell it in, 5 years or whatever for, $20 million, okay? They're going to need to, and let's say that at that point, the value of the building is allocated to the building in the sale is, let's just call it $15 million, just to make the numbers round. They're going to have to purchase, and they do a 1031 exchange, they're going to have to purchase at least $15 million of quote unquote section 1245 property in order to avoid section 1231 recapture overriding the rules of section 1031. And you can say, well, okay, I'll go buy more qualified production property, and, you may be able to, but given that, qualified production property ceases to be a thing, meaning that it has to be placed in service by a certain date. If you sell after that date, there's a potential trap for the unwary there, even if you do a section 1031 exchange. And, you can say, well, I'll, buy my replacement property and I'll do a cost seg study, and then I'll have section 1245 property to, meet that threshold. Well, depending on how the numbers work, you may have to trade up significantly in value in order to get enough section 1245 property as a result of, enough section 1245 property to offset the 1245 property that you sold. The other recapture issue that comes up with qualified production property is that even if you don't sell it, there is still, recapture, sort of as if you treat it as if you did sell it, if within 10 years, the qualified production property ceases to be, quote unquote, ceases to be used for a qualified use and is, quote unquote, used by the taxpayer in a productive use that is not a qualified use. Now, there's a lot in that section of the bill, and, Sky and I have discussed this pretty extensively, exactly how unclear it is. And it really comes down to, well, what is, productive use that is not a qualified use? Meaning if Sky's, client in 5 years, takes this manufacturing building and turns it into a, leases it out to somebody who uses it as a bowling alley. Is that a productive use? I mean, does that trigger the recapture? It's not clear. We're going to need Treasury to, clarify this. But, until they do, this is something which, we need to be aware of and proceed with caution. But with the exception of these downsides, the, QPP, qualified production property benefit is really wonderful and really amazing. And somebody can take advantage of it, then, well, they absolutely should. And Sky, am I going back to you now?
No, you should do the cost. We're
Oh.
at 179.
All right, so sorry, I did not have we have an agenda, I do not have that.
I'll tell you, I can do it. I'll give you a break. I'll do the agricultural
No
land
problem,
loans.
I can do bonus depreciation.
All right, all yours, all yours.
All right, so, we referenced now in the qualified production property section, we referenced bonus depreciation and 179 expensing. And while bonus depreciation is really a great thing, it says that basically property that has a depreciable life of 20 years or less, you can expense it right in year one, meaning depreciated 100% in year one. And this was enacted this has been enacted several times, or a number of times in history. Most recently, the Tax Cuts and Jobs Act implemented bonus depreciation, but it's never been permanent. It's, always been enacted for a brief period of time to spur economic activity or for whatever other reason. And, with the Tax Cuts and Jobs Act, they enacted it, but it phased out. And this year, it was currently scheduled to phase out by the end of 2026. This year it was at 40%. And what the OBBBA does is, well, it makes it permanent, which is, really cool and really awesome, because now you can do people who own real estate can do a, cost segregation study where they take the real estate and they go in and they pull out the individual components that are this, quote unquote, personal property and that have shorter depreciable lives. And they can, then take those depreciation deductions, they can expense those right in the year that it's placed into service, which speeds up the depreciation deductions and is really a phenomenal, wonderful thing. It is classified as I said earlier, quote unquote, section 1245 property, which means you have recapture issues. However, in a lot of cases when it comes to bonus depreciation and cost segregation studies, the depreciation recapture is less of an issue because by the time people go to sell it, the fair market value of this, extracted personal property, if you will, is just not that much. So you're able to get away in a lot of cases with just saying, well, okay, look, we had this, property which was, had a 7-year depreciable life and we're selling it after, 10 years or 15 years. Okay. It's really not worth anything. And, as a result, that does not, come up as much. And that means that does not come up as much in the 1031 context, either. Now, 179 is another really cool thing. It allows taxpayers to expense the cost of, certain qualified property that it acquires for use in the active trade or business. And qualified property consists of quote unquote qualified improvement property, which is basically certain improvements to the interior of a building that's already being placed in service, with certain exclusions that I won't necessarily list, and then a bunch of other things like roofs, HVAC, fire protections, and security systems. And previously, the limit on 179 expensing was $1 million, meaning you could expense up to $1 million. But that limit was phased out to the extent that you placed 179 property in service, and that 179 property exceeded 2.5 million. The OBBBA basically increases these, thresholds. It says, well, the limit is now 2.5 million, meaning you can expense up to 2.5 million of 179 property in a given year. And the phase out amount is 4 million. And these changes start in 2025. So you can do it this year. And once again, basically what it comes down to is, more accelerated depreciation in layman's terms, if you will. And with that, I will turn it back to Sky.
Okay, coming. I'm just going to cover one more oddity in the bill. They love rural land, they love farmland. Yeah, as we talked about with opportunity zones, there's going to be 2 more goodies for rural areas that we're going to talk about now. Agricultural land loans, there's now a 25% exclusion from taxable income of interest earned by banks or insurance companies on loans that are secured by agricultural land, as long as it's a new loan made after July 4th, 2025. And it can't be a refinancing. So what that means is it will, because of the exclusion for taxable income to the lenders, there will obviously be a lower interest cost to the borrowers. And when you combine this with the opportunity zones, what will happen is that there will be very favorable financing available for acquiring property in opportunity zones by the rural ones, where you get this benefit of an additional 30% exclusion from taxable income of the deferred gain. And so that is just one, again, small benefit. And the last benefit for farmland is the deferral of gain on a sale of farmland. And I'll let Mike do that one.
Yeah, so the last topic we'll cover briefly is gain on the sale of farmland. And basically, if you sell quote unquote qualified farmland to quote unquote a qualified farmer, you can elect to pay the tax in 4 equal installments, starting on the due date. The first installment is payable on the due date for your return for the year of sale without extensions. And so on and so forth for the next 3 years. Now, qualified farmland is real property that is located in the United States, has been used by the taxpayer for farming purposes, or is leased to a qualified farmer for farming purposes for substantially all of the 10-year period ending on the date of the sale. And also it has to be subject to a covenant or restriction prohibiting it from being used for anything other than a farm for the 10-year period starting on the date of the sale. So
Right,
essentially
1031.
it needs to be a farm for 20 years. So you have to meet those thresholds. And a qualified farmer is basically an individual that is engaged or actively engaged in farming. And that has a technical definition through reference to the Food Security Act of 1986. So that is another just oddity that is included in
Buys the land.
in the bill. What?
Not
Okay, sorry. That is included. That is just another oddity that is included in the OBBBA that that provides a benefit to the to rural people who invest in rural properties. I see we have a few minutes.
we have a couple of questions.
Oh,
that,
okay.
And I'll do one of them.
Okay.
1 second. Somebody is asking if they buy Dunkin' Donut businesses in an opportunity zone and they only own the business, will they get the benefits of the deferral? And the answer is no. You can't just buy a business in an opportunity zone. That alone does not get you there. You have to do substantially renovate the property or construct the property. So that requirement of the old bill still carries over to the new bill. And Mike, you may be able to give. And then there's also a question: can you do a 1031 exchange into an opportunity zone? And I'll let you handle that one.
Yeah. So the interplay between 1031 and opportunity zones is tricky. You can, but you're not going to get the benefits, meaning the exchange investors are not going to get the benefits of the qualified opportunity zone tax rules, because in order to get the benefits of the qualified opportunity zone tax rules, you have to invest through something called a qualified opportunity fund, which is by definition either a partnership or, for tax purposes, a two-person LLC or a corporation. And for 1031, you have to acquire real estate. You cannot acquire an interest in a partnership or corporation. So if you have a partnership that is doing a 1031 exchange, presumably they could exchange into a property in a qualified opportunity zone, and then substantially improve, declare themselves to be a qualified opportunity fund, and and then substantially improve the property. But the investors in that partnership who benefited from the 1031 would not get the opportunity zone benefits. They would not have qualified investments in the partnership. The partnership would need to take on new investors who are rolling over capital gains once it establishes itself as a qualified opportunity fund. Or qualified. It could also be a qualified opportunity zone business that would then need a qualified opportunity fund to come in and invest cash in exchange for an interest. So unfortunately, you cannot do both. And I see the other question is, do opportunity zone benefits apply to both commercial and residential and commercial properties? Yes is the answer. So long as you meet the original use or substantial improvement requirements, it can be any asset class.
Yeah, but which answers that last question. You can't just buy land in an opportunity zone. That alone doesn't get you there. And just buying a business, a Dunkin' Donuts business, that won't get you there either, because doesn't meet the substantial improvement test.
Yeah, you also have to, the opportunity fund or QOZB has to be engaged in an active trader business. And the regulations specifically say that just doing a triple net lease, which is presumably what you would do in the Dunkin' Donuts situation, is not the conduct of an active trader business.
Yeah. And with that, we've got to our 11 o'clock, and so we'll let everybody go on time. And it has been an honor to have you all join us, and thank you very much.
Agreed. Thank you very much for joining. And please follow up if you have any further questions.
Yeah, any questions you can send to us and we'll answer via email. Cheers.
Bye-bye.